I'm joined in the studio by Piers Hillier, Chief Investment Officer of Liverpool Victoria Asset Management. Thanks so much for coming in to speak to us. So what are your thoughts on this? Where do you stand? Should investors be going into stocks instead of bonds?
It's a fascinating dichotomy at the moment because the bond market's telling you one thing and the equity market's telling you something different. We have record low yields, and normally for an equity investor, I've spent most of my career picking stocks and I use my lead indicator as the 10-year bond yield in the States. And that's really giving a very cautious signal. By contrast, we've got BHP this morning, another M&A deal, and I think that's why the stock market has been, has diverged from that classic correlation, because we've actually got consistent bidding taking place for assets, whether it's in the UK or across the world. We're seeing corporates basically saying, we've put our houses in order after a recessionary period, and now, given the cost of money is so low, let's go out and invest that money on behalf of our shareholders, and BHP are doing the same. Question mark, are they overpaying for the assets? To my mind, in the commodity space at the moment, there really is a search, for reinvesting cash. Most of the corporates are cash rich after a very strong period for commodities, and so they're looking to buy assets because to them cash is cheap and real assets, are attractive in terms of a structural long-term phase. Right,
so with that in mind, is this a sign that M&A is returning? We're seeing a resurgence, if you like?
Absolutely, and I think that's why you've had that split. Effectively, you've got equity investors saying, I've got a 3.5% dividend yield, say, on the UK, I've got the same out of the Dow in the States. Why would I want to go and buy bonds that only offer me 2.5%? Basically, you're telling me we're going to have low to no growth for 10 years. Now, if you think that's the case, then absolutely fine, but remind yourself, you've had no real return from equities for 10 years already.
Right, so what does all this mean for investors? Are we likely to see a downturn in the equity market going into the second half of the year?
Certainly, the market's already pricing in an expectation of a slowdown, and it's easier for me to come on here and be bearish because I have the moral high ground rather than come on here and be bullish. But the fact of the matter is there's value out there, and eventually people will say, you know what, I'll actually take a little bit more risk to generate that return. And we've seen that with actually the corporate bond market trading more positively in line with demand for gilts. And that normally says that this isn't just simply a risk trade that's going on at the moment, it's a realignment. Now, I still want to understand why we're getting that big divergence between the 10-year and the equity market implied yields. But that's really the debate we have at the moment. It's the summertime, so often markets are slightly more irrational. There are not as many players around. We don't tend to get big directional moves. So, to my mind, September will out when most of the major players are back. We see the autumn. We start to see the expectation of what Q3 looked like, what Q4 order demand looks like, and that really will be the next indicator as to whether the markets, equity markets, rise or fall from here.
Right. So where should investors be putting their money right now?
Well, my thesis essentially is that there is more value to be had in the equity market, even if I'm just looking from an income point of view, let alone on a valuation point of view. But I do understand that, when you have economic headwinds, the equity market is a lagging indicator rather than the leading indicator. The bond market, the discount rate, is your classic sign of what the market expectations for growth are. I think we've got overly cautious. Classically, if you look at, we've only actually had two technical double dips in the last 100 years, in 31 and 81, and both of those were driven by policy errors, by interest rate setters in the US. Where we had
so you're not very concerned about deflationary pressures, very briefly?
No.
OK, thanks very much. Short and sweet. Piers Hillier, appreciate your thoughts.